on the right. So what we'll do is we'll just wait a few seconds to make sure that everybody has the time to get in, and we will gently start the event. So as a quick reminder, tonight the event is about what investors are looking for in startups, and we also have a very special announcement at the end of the event. So you should stay around for sure. Great. So and also you should be able to ask questions in the chat. And basically how this event will go is we will ask a couple of questions that we already have, but at some point we would be glad to get some questions from the people that are watching the event. So put your questions in the chat and we will have a look, and hopefully we'll have the time to go over everything. Cool. Great. So how's everyone doing here before we start for real?
All good.
Good. I know. Yeah, a special mention to Sarah, who I think is in Singapore, right? And it's 1 a.m. if I'm not wrong.
Yeah.
So yeah.
Still quite lucid as well. Still quite present.
Yeah.
That's commitment, Sarah.
That's really ambitious.
Thank you very much, Sarah.
Yes.
Awesome.
24 hours a day. Yeah, we are doing pretty good. We are based in Austria, Vienna, Oliver and myself, same company, same place. So it's just super freezing, super cold as usual. So
yeah, it's getting cold for sure.
That's what we do, right? We talk about the weather and support startups.
Yeah.
Austria and Liechtenstein actually, but the weather is quite similar, I guess.
Yeah, I guess so. All right, so let's start. Actually, we have so many things to discuss, so let's not wait too long. So hello everyone, my name is Anthony Fender. I'm very glad to have this event tonight. We'll be talking about what investors are looking for in startups. I think this is a very hot and interesting subject because basically I think 2022 has not been easy for everyone. I think there's lots of amazing projects out there that are looking for investment, and sometimes there are like great projects, great ideas, but there's a few things missing here and there to make it an amazing project that will attract all the investors. So tonight we will want to talk about all these subjects. And yeah, so we have a few questions, and then we want to take also questions from the chat. So yeah, you can get things rolling in the chat, say hello to us, and let's get started. So tonight we have Sarah Simeone, CEO and co-founder of Nifty's, joining us from Singapore. What's 1 a.m. We have Paul Krugel, founder and CEO of ValueX, and Oliver Schmidt, founder and CEO of ValueX, as well as Benedek Orban, the co-chair of CVA Startup Working Group. So actually, we'll be starting with Benedek, who has a few interesting numbers on what this year has been like for everyone. So I'm going to leave the floor to Benedek.
Yeah, thank you very much. Can you hear me?
Really well.
Okay, that sounds good. I'm sharing my screen. Can you confirm seeing my screen?
Absolutely, we can see it.
Okay, so yeah, welcome everyone. Thanks for the introduction, Anthony, and welcome also to our other panelists. I'll be doing a bit of stage setting for the panel, which we will have. So it's not a separate presentation in these terms, actually just triggering your minds so we can have a fruitful and interesting panel discussion right after. So before jumping in, maybe one of the major questions which we put out there when marketing this event was, who wanted that unicorn? But before, I'm not aware to what extent the audience is educated on that. And let's just clarify first what is a unicorn. So the term unicorn refers to a privately held startup company with a value over $1 in billions. Okay, so over $1 billion. It is a commonly used term in the venture capital industry. So sorry for those who didn't know it. It was a catchy one, so we just took it. But we'll get back to it. Why it's important to know and use this term unicorn once again in the stats. So when I was preparing for the event, I talked to many of our member startups, a handful of VCs, also members, but also went out to talk to my network. And I could say I did a non-representative research. I looked into the market vibes also in media and just to see the actual situation so I can put it out here for you. But before I forget, along my preparation, I found many great articles out there to read. They're like very new ones, fresh ones, and older, very good ones as well, which I thought if I have collected them already, I want to share this with our members and share this with the audience here. After this call, it will be in the deck, which we will also be sharing with the participants of this call. I think these materials are really do make sense for those funders and startup owners who care about the idea of their startup and they want to survive in these market conditions. So now, instead of putting out the top 5, top 7, top 10 actions, which could bring you the next funding for your startup in those turbulent times, I'd leave that for the upcoming panel and just throw out in the next couple of minutes, as said, a snapshot of the market, of the funding market, what's out there. So we see a unicorn and we see a number there. It's 2021, it's the year. So last year, venture capitalists went on a spending spree, I could say, funneling crazy amount of capital. I think we all saw that into startups with ambitious growth plans and large total addressable markets. And it was actually, to be honest, but we will hear this confirmed or not, but this was actually a good year for investments. But a year later, actually what happened that investors are expressing a new tone called hesitancy, which might end in a certain death of couple of unicorns, but also for smaller startups. It's very challenging and it can be challenging to get to funding. We see a sharp decline in public tech stock valuations and rising interest rates and brought on by inflation. These are all changing the dynamics between funders and investors. And to be honest, as I've talked to our members in the CVA startups, they just confirmed that no longer the growth curve on the third slide of their pitch deck gives their funding. Like they need to really change to get there. But there is hope. It's not impossible. So we have a harsh economic situation. I don't want to go deep into that, but inflation, as mentioned, and an energy crisis, war, many factors have a combined effect, which just make it hard. When I looked at it into the media as a preparation, what we saw here is, you see the headlines. Venture capital deals sets worst drop of 2 decades. Crisis of the VC market in Europe, in the European investment funds. European startups seem reckons. So these are all, of course, clickbait. But to be honest, they are to some extent true. I hope to get this confirmed, but also it can be challenged in the panel later. Yeah, so the snapshot which I could take and the silver lining of it was there is a drastic investment contraction. US and China, just to take 2 large markets, face in the fresh deal making, staggering -45 or 50%. I'll add all the, you will see the resources for that or the sources for those information. Europe, if we say Europe, a major factor in the slowdown in this investment in the European startups has been the drop in the large, so $1 million euro plus rounds beginning on the summer. And to be honest, in the first half of the year, it was still okay. We could still close 133 of these mega deals, but in the Q3, it was only 37, which is actually very much going down. And I'm surprised. I would be surprised to see even a number above 20 for 2022 Q4. Here we have once again a dehornation. I called it dehorned. So at least 45 startups were dehorned already this year, which in 2022, which means that they were slipping below their market valuation of this magical 1 billion. So how does the Swiss do? We are located mainly in Switzerland, the association. So I just wanted to really look out. The Swiss are special. That's true. And surprisingly, or not surprisingly, Swiss do well for now, I could say. The Swiss market in the first 11 months just got Swiss francs 304 billion in VC capital, which flow. So in the first 9 months, which were given out and financed. And very importantly, to add here, that 2 major deals, as said in the third bullet, were really pushing this number up. So Swiss look good for now, but in 2023 they will also be affected, and it will be seen also in the numbers. Moving on, this was I didn't want to bring too many slides for you, but I just wanted definitely to bring this one because this was the one I found on Bloomberg. First in a Bloomberg article coming from Precon. I think the chart itself speaks for itself, but to sum it up, the value of the new VC deals globally, that's a global chart, is down 42% in the first 11 months. That's year to date, so roughly 41.6. And this actually does mean that that's the deepest slump which ever recorded in the last 2 decades. So since the 2000s, that actually means that it's even worse than in the 2008 crisis and the aftermath of it. So it's very, very serious. Yeah, I think I wouldn't go too much deeper into it, but maybe because we called Crypto Valley Association and we have many members from that perspective, I just want to add, and we cannot get around the fact that all those market turbulences in the crypto world and ecosystem caused by the shameful collapse of many parties, should it be FTX or Luna, they all brought VC capitalists to pull in the brakes. Several of the biggest startup backers in this niche have retreated after they have really high-profile troubles in their portfolio. Just to give you an example, Sequoia Capital, one of the giants in Silicon Valley, they actually plunged into crypto this year, $600 million in funds, and only just to see they had to write the whole 600 million off this year. The same happened to SoftBank Group. The same happened to the other big ones like Tiger Global Management. So they were aggressive supporters of this niche, which we are working in, or many of us are working in, and now they burn themselves. So this is, if we just want to remember one chart, this is the one. Is the game over? I asked myself, well, let's discuss in the panel later, but I also found many good articles on that in my research, how, if it's over or not, generally it says the market will heal itself and the strong and the good will get out and the market will be cleaner. That's the main message. And I would just maybe finish off with this quote from Edith Young, the partner from Raise Capital, where she says the worst time could be the best time to invest in tech. And she's bullish on the early, so very positive on the early stage tech startups and the technology advancement right in these critical moments. And as said, and I mentioned earlier, Goldman Sachs is actually buying up startups in this niche. So very important moves where the big moves are. So how to survive? The last 2 slides I want to give to you. I just run into a very nice Harvard article. It's actually from 2020. So the question is how to survive. And I just want to give you 2 steps. Those are not advices, but which we can discuss later within the panel. So the step 0 is move to a survival mindset, which was put out by this Harvard article. This actually means that we startups shall think like camels, not like unicorns. Why? Camels can survive for long periods without food or water and adapt to extremely harsh climate conditions. So founders who can adapt to the current economic climate and survive these longer periods, equivalent to food of water, I mean here VC funding, those will be able to weather the current uncertainty and grow bigger probably after that. So that's the step 0. And the step 1, understand what your investors look for. Many great articles out there, but we'll have today even a much greater discussion on this question. And now I'm handing over to, and actually back to Anthony to start and kick off the panel. And thanks for your attention.
Yeah, thank you very much, Benedek. I think this really sets the environment really well, and this definitely raises a few questions on VCs and why they're slowing down. Does anybody here want to bounce back on what has been discussed up until now by Benedek?
Maybe one point from my side, because I found it interesting that you showed the effects of the dot-com bubble burst beginning of the 2000s, which was actually when I started my professional career in telecommunications. And I experienced also that we back then started also a startup within our mobile operator company, which we had to close then after one and a half year already, because it just didn't work. And the second crisis in 2007 and 8 was actually the time when I established my own company and became an entrepreneur. So I already have experienced these downturns. But if you look at it, and if you look on when in which periods of time the big tech companies that we know today evolved and made their progression, you find out that it was exactly these days that brought out these big business models. So this is something we should think of when we look on such downturn periods.
And what I would like to add here is everyone is so fast with calling it a crisis. And I think from my experience working at ValueX and being in the crypto space for 6.5 years now, so technically on paper I was a billionaire, and I was a couple of times broke as well, like everyone in the space, I suppose, is that the founders that have been taking their project serious as in really driving it like a business, they have not been confronted that much with the trouble now, because they have been dealing with their project and business as a business. They have been preparing for these downturns. They have a leeway that is not just 2-3 months ahead, but maybe a year or maybe even 2 years ahead. So for them, of course, it's getting worse, as in not having so many calls with VCs and maybe having more difficulties raising Series A or B. But there is also the flip side on this, right? There is the new guys coming in that seek for funding. They have definitely more trouble. But the ones that are already in the space, I don't think that they have that much trouble, to be honest. At least that's our experience from when we talk with a lot of different startups in different stages. And to be honest, the media is always very quick calling it a crisis and a crash and a downturn and everything like that. And I don't want to downplay it, but us particular in that niche, I don't think it's that bad, because you should just focus on your business really, and do and work on the value proposition and the business model, and on your team capabilities, and just push through it. To be honest, that's at least my experience when it comes to that.
I'm gonna talk on the startup side at this point. Of course, I mean, Benedict just showed us some interesting figures, but they are also for startups at a later stage. When we're talking about unicorns, of course, I mean, it's very easy for someone who's already raised the Series D to actually raise even further money. So most of the times they're full-on rounds. But when it comes to startups that are starting now, and I'm talking about the pre-seed and seed stage, we all know that in Europe, especially in Europe, this situation is getting worse and worse. And that's not dependent on a crisis. It's dependent on the investors that are basically making the actual, scene of the pre-seed and seed. And that's due to also our own, let's say, backgrounds and values as Europeans, which were very risk averse, especially compared to the Americans or even some people in Asia that I talk to quite frequently. And also when it comes to Web3, I see that the expectations are very much sometimes unreal, especially when it comes to VCs that are coming from a Web2 background and they want to apply Web2 metrics to a Web3 startups, especially when it comes to valuations. And that again, it's a game that it's up to us as entrepreneurs to educate these people. But then of course, I mean, then you hear every single day, stories like FTX that we've witnessed, in and out, inside out, for the past few weeks. And you really ask yourself, how could, a person with very little experience, manage to actually raise so much fund from the likes of Sequoia that then claims anyway to actually, write off like $600 million because of bad investment decisions. And that brings me back all the time to how you judge startups, how you judge founders, how you get to know founders. Most of the times we've been studying this quite a lot, as a company, how investors invest. And I'm sure that, we got Value X here today anyway, but we know that over 90% of the investor deal flow comes from referrals, from peer referrals. And that sometimes hurt or harm really founders like myself, for instance, who are women, who are just, starting in Web3 with a technical background, but don't have the connections or the right connections in the right places sometimes, to actually get noticed by investors. Even if then, after a lot of hard work, we managed to get funded, by the likes of Animoca, but, it took a lot of time, it took us 3 times as long as the 20-year-old guy who's based in the US or based in a very cool hub and mingles with investors on a daily basis by playing golf with them. So that is basically we need to demystify as well the relationship between investors and founders. I think that is very important also for a lot of startup founders who are starting to actually get, into this space.
So yeah, sorry, go for it, Tony.
What I've just want to tell a personal story maybe is that one of the teams that we support, and they have been looking for funding for 9 months now, and for the first 8 months or so they have not been working with us and recently they started working with us, and they showed us the pitch deck at first, and the pitch deck basically had crypto and Web3 plastered all over it, with the possible returns, with comparisons to other billion market cap projects. They, of course, left Celsius out and put another one in that had still a billion market cap, and they were wondering why they wrote to 250 VCs on these, commonly shared VC lists that are all over the place and LinkedIn and everywhere. Everyone is sharing them, and they didn't even get a single reply. And usually when we start working with them, and I don't want to sound like but very common sense things, like core business things, like what is your actual business? What is your business model? Because selling a token is not a business model. That's a liability because it comes back as a sell pressure at one point. Like, how do you imagine making revenue if the market is not happily throwing money at you? And you know, and this is just hard work, and this needs to be answered, and you need to have answers to that, and then that makes things a whole lot easier. And thus far, we've been pretty successful with the team. The investors start replying now because they see there is a business plan, there is a financial plan, and I understand, especially as a German who takes fun in these kind of things, like business plans and financial plans. I understand that they are boring and they are annoying and they are tiresome, but they are needed. They are not so much needed as in everyone will look at every little detail and say this customer acquisition cost here doesn't make sense, or is $2 too high or $2 too low, but more in a sense of you did your homework and you realize what moving parts need to come together to actually drive a project to a business, right? And you're not just a guy that's or a founder that sets on trends and on hypes cycles, and you just are there because everyone else is there. And I think we are really scratching the surface already when it comes to trust, because in my personal opinion, I think we don't have a VC crisis or founder crisis. We have a trust crisis, so to speak, right? Because all of these downfalls this year, Celsius, Terra Luna, Do Kwon, you know, bragging on Twitter, have fun staying poor, throw money to us, and all of this stuff, and even Sam Bankman-Fried to a degree, they all misused the trust that we had in them, right? And Sequoia trusted BlackRock, and BlackRock trusted all the other guys, and so on. No one looked into the books, right? And no one did their very basic due diligence that they do with every little startup that wants to have 10,000 euros. They will look into the books and turn every stone around, but with the big guys, no one does it anymore because someone else probably did it, right? And I think, like, when I look back at our work of the last years, I think mainly it's about building trust, really, and convincing that we can survive, and convincing that we can deal with obstacles, and that we are prepared for obstacles, and that we dealt with things that did not work well in the past. So maybe that's also a topic where we can talk about everything that's trust related, really.
Yes, and trust sometimes is also linked to unconscious bias. And we can definitely, you know, see that, and it's actually a very, let's say, subjective measure most of the times. And we know actually as well, again, by research, that most of the decisions that are made originally from investors are very subjective. They are not objective, and most of the times, you know, even financial forecasts could be thrown in a bin, because these numbers are most of the times made up, especially in a Web3 environment where, you know, there is very little traction. So, you know, how could I or anyone else in this industry forecast the correct cost of customer acquisition? You know, and I come from a background where I was actually dealing with this information, by the way. You know, so it's very, very much like, you know, a work of art, a work of research, but also like, you know, a real forecasting process. That needs to come from, like, you know, understanding the market and getting, like, you know, start experimenting a lot with different products. And that is where, you know, you need capital, because, you know, even if you have a brilliant idea, you still need to get and test different go-to-market strategies that could have different cost of customer acquisitions and have different impacts on the actual bottom line of the company. And that is, like, you know, related to the trust, related to who, you know, who would be the best person or the best team to actually go and find these things. And, you know, on the team side is definitely very important, but then we're also seeing, of course, all the time in Web3 a skew towards tech teams. And, you know, even if tech people are amazing, and my co-founder is a tech, you know, blockchain developer, but still they are not necessarily built to build businesses or to make business decisions, savvy business decisions. But yet, they are the ones who get funded the most. And this is something that I never get my head around, to be totally frank with you. And now I speak to investors, and perhaps you can shed a bit more light on that as well.
Mm-hmm. I mean, definitely there's I would say 60% of the projects are from developers to developers, right? And of course, it has its niche, it has its market. And I personally like these projects because I'm a somewhat of a nerd and tech nerd myself, in a way. But I also understand, like, if we really want to move the space forward, right, we should stop talking from one crypto sys to another crypto bro and saying everything's awesome. You know it, I know it, so let's work together. Because the real challenges are out there, right? And the real challenge is my wife, as stupid as it sounds, who doesn't know a thing about crypto, and she should not, to be honest, and she should not care, because as the solution needs to be a good one, right? The problem solution fit should be there, and it doesn't really matter what kind of technology it is. And I feel that especially in the crypto space, we sometimes fall too quickly in love with the technology side of things, and with transactions, and with decentralization, and all of these things, right? And the gains that we made and the losses that others did. And but at the end of the day, it should be a solution to a problem that a lot of people have, and that solution needs to be better than what is out there. And that should be the basis where everything starts. And you're right, there's a lot of tech people, but I also see that a lot of tech people are realizing that tech is just not enough to get it started, right? Because tech can be exchanged, and tech is usually something where you can just throw a lot of money at and be the competition, right? So that's at least what I think.
Maybe if we look at the market and its conditions right now, I would like to quote Warren Buffett, who said that only when the tide goes out do you discover who's been swimming naked. And so I think that's what we experience right now, because the tide is gone out, and we now see that there are some projects out there that have just been swimming naked. And what I find is interesting is that still there are projects with actually trying to get funding without really a good basis, without really a sound conception. So, for example, what we see every now and then is, okay, this is our idea, and there is a competitor in Web2, and they have 100 million customers, and we only need 1% of these customers, which will be 1 million, and that will make us successful. And if you then ask them, okay, and how you gonna get these 1 million customers, there is no answer. So this is for me a very good example, which we meet every now and then, every week, where the homework has not been done. Yeah, and this is actually the basis. This is a given. Yeah, you need to know your market. You need to know how you organize your go-to-market strategy. You need to have an answer if you're questioned how your business model works and how you're gonna generate revenues. This is a given. But what Paul mentioned is, I think, really the most important part, and actually where we put the most work into it, which is building trust. And I would say that one of the key elements in really achieving the funding you need is to realize that if you start to talk to investors, the one thing you don't have from the investor side is trust. Yeah? So they don't regard you as being a liar, but they know that you will do everything to present your project the best way. And this is something that every startup has to face, because if you think about it that way, and if you put yourself, in the position of the investor, you realize that having a smart pitch deck and a wonderful, bright presentation is only one small piece of the whole picture of building trust. So I would say that this is really the most important step a startup has to take.
Yeah, and I agree in a way, and but with regards to numbers, don't you think that this is actually almost the fault of investors who have instilled this culture of the hockey stick to a lot of entrepreneurs, pushing them to actually inflate a lot of numbers in their decks? Because I was a mentor of a lot of startups throughout my career, and I've seen a lot of investors and a lot of advisors telling these startups to actually inflate the numbers, when I was actually saying, there is no chance that you're going to do this with the cost of customer acquisition and the budget you've got and the strategy that you've got in place. And that was actually quite scary, but we still seen a lot of these, startups being funded and then going busted, and the story repeats itself. So you may be some of the best investors here. I have to trust you as well, because the trust goes both ways. But there is definitely a culture within the investment space that there needs to be addressed. And a lot of founders need to understand that, yes, it's good to be ambitious, but having these hockey sticks is also very unrealistic. And I think, that communication needs to happen.
Yeah, I think you mentioned a very important point, Sarah. And this is that, of course, also on the VC side, right? There is different type of VCs, different type of mindset that are taking place there or are shaping there, right? From you mentioned Animoca Brands. At the high times, they were basically joining a chat 20 minutes late, listened to it for 10 minutes, and then they wrote a check for 500K. These times are over now, because they also realize they have to check their portfolio and keep it more in balance, right? FTX did even worse with Alameda Research and all of these big boys. But I think it's also a strategic decision that the startup needs to make, right? Like, which type of VC do I want to appeal to? The type of VCs that wants to see high numbers, that wants to have a 10x, a 50x, a 100x, and that is more after the numbers, or one that is more of a strategic long-term partner, right? And that maybe has some different value adds besides just dumb cash at the end of the day, right? And I mean, there is so many VCs out there. Like, you don't have to pick the first one that says yes, right? Or you should not, at least. That's my advice. Like, please have a look first, and please really ask yourself, do you want to keep working with these people that you just met, and just because they were the first to say, yeah, I give you the 250K or 500K or whatever it is, are you really sure that you can come along with them, that you go through trouble with them, that you go through success with them? What happens if they say half a year down the line, okay, now we're exiting because we made our bucks and it's fine, and we don't really believe in your long-term vision? And I think this also needs to happen, right, on the startup side, to be real to themselves, what they are looking for and what is their strategy. And it's totally fine if their strategy is to make to be a unicorn in 2 years' time and make a good return. That's a different type of VC than that they should look for. But that needs to be self-reflected before they start reaching out to investors and then say, oh shit, and now we have 5 investors that are only after the return, but we would like to change course, and they say no.
Yeah.
Sorry.
Yeah, just to bounce back on the little story that you were saying earlier about the startup that you knew that was sending emails to lots of VCs and not getting answers. My personal opinion is that in Web3, a lot of projects actually really look alike. Sometimes use the same images, or sometimes present themselves in the same way. And one burning question that I have, and I think a lot of people want to know, is what is that special thing that investors like you are looking for in startups? What's like, because yeah, to me, so many projects look alike. When you are looking for a project to invest in, what is what are you looking for?
I think it's and you can continue shortly, Oliver. Is that I think first of all, I don't think it's trust. It's more like believability
Trust.
in that believability that you can actually execute what you're promising, right? Because I mean, we are dealing with so many super smart, sophisticated technicians from Google, from Microsoft, from Meta, etc., pushing into this market, right? And so all of their CVs and all of their pitch decks pretty much look the same, right? We have all the games have Epic in there, Unreal Engine, Riot Game, whatever it is, and all the tech teams have Microsoft, Google all over the place. So when it comes to facts, they are all pretty similar, right? And that's exactly what you mentioned there, and Anthony, right? They all look the same. They all feel the same. They even all write the same because they all consume the same type of media and recommendations that they see on LinkedIn, etc. So, for example, one of our partners, a big fund, they get on average 250 applicants on their form field per month, right? 250 applicants with pitch decks, business plans, financial plans, blah, 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 blah. How on earth should anyone go through that with a deep thought and spend, I don't know, 30 minutes on that? No one's going to do that. So what they do is they automate most of it. And the rest that is left over, they spend maybe 5 minutes on it. So you have a very short attention span to really bring across your differentiator, right? And therefore, I can only say there is no magic pill or magic answer to everyone. But what you should look for is, if you take yourself out of your view as a startup, like if you put everyone with the same factual capabilities next to each other, what has your team that the others don't? Like, is it because you've for example, you have a data center, you understand how these data centers work, and you actually speak the language of the target group that you are going for, right? Or is it because you have been longtime friends, you played in the kindergarten already together, and you just know that you will survive any type of trouble and growth trouble that will happen in a startup? Like, what is the soft differentiator and not the hard differentiator to all the other startups? And what did you learn from them?
Yeah, sorry, Paul. Before Oliver, you jump in, I would maybe just specify this question in the way, or a question of Anthony, and with regards to the revenue. Because I've been talking to some startups running up to this event, and they said that the standing of the VCs towards the revenue and the revenue generating profile of a startup has changed in these crisis times. Can you confirm that, or can you just say no, that's not true? You just look the same way at fund ideas and vision, and the same way at the revenue generating profile of the company?
To be honest, I think it didn't really change much. But Oliver,
I wanted to say the same. Yeah.
Okay.
Yeah. I cannot agree more. I would say what really has not changed and will never change is that investors are actually investing in the team, as Paul already mentioned. And of course, you need a smart business idea. And of course, you need a smart solution. And of course, there has to be a realistic market opportunity and so on. Yeah, and that's a given. But at the end of the day, it's investing into a team and having the reason to believe that this team is capable of transforming, and this is maybe really most important, of transforming the status of a project to a viable business. And this is a transforming process, because at the beginning, you have a smart idea and you are a group of friends or colleagues, and I always tell them, but you don't have a business yet. And until the point that this is a viable business, you have to go through a transforming process, which is not always easy, and which will also, cause sometimes of frustration, and sometimes of hard work, and maybe also sometimes of quarrel. Yeah? And so the investor has to be convinced that this team will stick together all these steps and will be able to manage all the challenges that are will come up on the way. So that's, in my point of view, the most important point here.
Yeah, did anything change? Because you said that did not change. So that's actually not confirmed what the startups I've been talking to. Maybe it was not representative, but the focus is not more set on revenue and on runways, maybe to the back, like especially in crisis times. But did anything change in your approach? Or you can just say that nothing changed?
In my opinion, nothing changed, because the type of investor that was looking for big numbers and for the big next billion-dollar unicorn is still looking for that, for those big numbers, for those big market opportunities, capturing disruptive business models, etc. And the small, mainly European-based, coming back to what Sarah mentioned earlier, European-based fintech, deep tech, ESG-driven type of companies, that's more of a European type of thing, they are happy when they have a 50 million, $100 million business, right? And then these type of investors are mainly looking for, okay, customer acquisition costs, runtime, leeway, burn rate, churn rate, all of these things. So in my opinion, not much has changed from the expectation. But again, coming back, you first have to have an idea what type of investor and partner, because it should be a partner, right? And not just someone that gives you money. You're looking for, especially all these accelerator hubs, for example. There is plenty to choose from, and you should just not apply to all of them and take the first one that meets your criteria on the cash that you get, right? You should look for what type of environment you're going into, right? Like what is the other companies there? Can you learn from them? Can you make network connections? Can you improve your skill? Does it challenge you, or is it just convenient, right? And it's right around the corner, and it's right in my city, and there's the other co-founder there, and I like that girl anyway who's working there, so let's do this 12 weeks and it's done, right? Yeah, well, if you treat it like that, then don't be so irritated when something doesn't work out, or if someone asks you difficult stuff, right? Because be prepared for that. And I know this sounds so not fancy and not sexy, but at first it's not sexy to have a startup, right? It's not easy, but it will become easy if you took care of that part in the beginning. Then you can focus and concentrate on all the other stuff anyway. And just to answer this, because I misclicked, Javier was questioning, like, because there is not enough Web3 data available. And I think this is exactly the reason why some startups maybe misinterpret this, right? Web3, in my opinion, is not much different to how you would pitch and how you would present a Web2 startup, right? It's the same type of markets you're basically going for. It's the same type of human beings you're targeting, and you're trying to solve problems of human beings. Just because you're utilizing a different type of technology doesn't mean you should now present completely different type of numbers. So I would say just stick to what you're used to. Use Statista, use the common resources, look at industry averages when it comes to customer acquisition costs. If you're a fintech, how much does Revolut spend? How much does N26 spend, etc., and then have an argument why maybe you spend less than them. It's pretty simple at the end of the day. You don't need to overthink this all the time, right? Because at the end of the day, there is no right or wrong when it comes to this, but you should have an answer that you have an idea how this works and what to look for.
And I couldn't agree more, Paul, because I mean, for instance, we are totally Web3, and I'm coming from, my co-founder, extremely decentralized everything, but I'm coming from a Web2 corporate background, and we need to meet in the middle in what we call Web 2.5. And for these reasons, we know that, we need to create tools that are easy for normal people to actually, use this, experience Web3 without the complications of the Web3 tech stack. Because to give you an example, we are an NFT platform for businesses. So we onboarded lawyers, consultants, business coaches, people who didn't even have a wallet. And we are training them from scratch to actually create MetaMask accounts, purchase crypto, and so on and so forth. And we realized pretty quickly that even if they are extremely happy to do something like this, we are not going to be able to scale unless we build custodial solution. And that took us really one month to actually realize after speaking to some of these people. And then is, when you have to change and adapt very quickly. And that is going to be launched in January in order to actually make sure that people can access and experience Web3 through their email address. And building a custodial solution that, enables everyone to access, because that is also building a good ecosystem, an ecosystem that doesn't really discriminate on anyone, because discrimination can happen in so many different ways, also in the tech that, you use and who can access that tech. And at the moment, Web3 is very exclusive. Even if it should be an inclusive ecosystem, it is very exclusive because only very technical people and people who understand, how to play the game can actually, access it. And that's why also there are very few women in this space yet again, because they are not, they're finding this extremely cumbersome to understand. And that is why we need to do our homework, and we have to be very reactive, proactive rather than reactive, right? Understand the customer, build on top of this, and make sure that people can slowly access Web3 and this, decentralized world, which is not going to happen today, is not going to happen tomorrow, it's probably going to happen in 2 to 5 years' time if we are lucky. And depending on regions, depending on, geos, depending on so many different things. And back to your question, Benedict, about startups as well. Oliver and Paul gave you their opinion from an investor point of view, but I can tell you from a startup point of view that I've been talking to a lot of Web2 and Web3 investors. On the Web3 side, I can see no changes, but on the Web2 sides, these are people that are applying, as I said at the beginning, Web2 metrics to a Web3 world. And when you're basically asking a startup, a Web3 startup that you can only get funded if you're achieving $1 million or euros in revenue this year, I reply at this point, then you're talking about probably 2 or 3 companies in the whole world at this point. So be realistic, or just basically change game or change career. And to be totally frank with you, I'm starting to be extremely clear and transparent with this, because you don't want to lose any time as investors, but neither in startups want to lose a lot of time. And we need to start educating investors as well on Web2 investors. I'm talking about Web2 investors that if we want to reach these numbers, we need support. And support comes in the form of money, but comes also in the form of, opening doors to strategic partners, going back to the type of investors that we want, right? We need to have good investors who have great connections in the Web2 space and can actually help bridging these gaps. Because if that doesn't happen, we are starting to build again the bubbles where just few people are going to be part of this bubble, the metaverse bubble that nobody, uses anyway. So in order to make more people use these metaverses and these great tools, we need more collaboration in the ecosystem.
Yeah, thank you very much, Sarah, for this. Since we do not have a lot of time left, I really want to have the time that we have left to really give some practical advice for all the startups that are listening tonight. Paul, earlier you were saying that you receive so many applications from so many different startups, and sometimes there's most of the time there's this automatic process, and then you maybe spend 5 minutes on a project. So my question is, when you have those 5 minutes, how do you spend them? Like basically exactly what information are you looking for? And maybe just like a checklist. So like once you're, so I'm guessing you're looking for information, then if it's good, you're moving on to the next information you're looking for, etc. So maybe let's try to go through like a little checklist of things that are very important and that you're looking for in different startups.
Just to clarify here, like this is not how we actually work, but like one of the biggest funds out there that we work very closely with how they work. We don't get as many, and but I think what they are all doing the same, and we are doing as well, is like to have this gut feeling that builds up that everything is there that should be there, right? If, for example, if I only see positive things and huge, Oliver made a good example like this. I've read it so many times. This, like, okay, there is this market, you know, and it's a totally addressable market of 3.5 billion gamers, right, worldwide. And the game that we are building, we only want to capture like 1%, right? Only 1% of 3.5 billion gamers. Yes, okay, but we are building an, I don't know, an RPG in space that has tactical things and a few NFTs in there. Okay, so that theoretically that 3.5 billion number is already slimming down, you know, like what type of platform, what type of game, you know, is it adult friendly, is it casual, you know, and the numbers go down and down and down. So if I see a number that is like the total addressable world, and they say they want to capture like 1% of it, then to be honest, then at least that gives me the impression that they really didn't think about this and really didn't challenge their own idea to begin with. To be honest, if I'm very transparent, I have a personal bias against Web3 games because they have been proven that 99% of them are not really worth your money or your time. Well, you can be lucky. I'm not saying you can't make money with them, but most of them have not been proven to have a viable business. And maybe that also plays into this question from Daniel here, your answer there. I mainly look at the business model, and if their business model is we have some transactions, and from these transactions we generate some fees, and we are selling tokens, and this is our revenue, then I'm sorry, but this is not revenue. This is not a business model. Selling tokens is not a business model, because these tokens should have a certain value, right? And you build this value by having a business that does not rely on beliefs, but rather on a sound foundation on solving problems and selling these services or selling products and something like this. So I would always favor, and all of the VCs that we work with and that we know, we would always favor a business that not only has a token side, but understands how to generate like hard cash, you know, where businesses and corporates and whatever it is can also pay with cash, and not just limit yourself to a very flaky and shaky crypto side, which it still is right now. So if
Paul, maybe I totally like the way you shape it, but if I would ask the question, you can just look at 3 slides of a full deck. Which were those 3? Which you would be looking at?
Amazing question.
Business model, market opportunity, not market size, and team.
Okay. How about yourself, Oliver?
Yeah, I would agree. The difference between market potential and market opportunity is something that is, you know, not a widespread knowledge, but it's really crucial. And so I would also say these 3 points are really important. And to give an advice to all the startups, it's really, guys, do your homework. And it's better to go the hard way now. Yeah, work yourself through and have an answer to every tough question. And then you have the basis to create trust, or how Paul put it, believability.
And how about you, Sarah?
Mind.
Thanks, Oliver. How about you, Sarah? If you could submit just 3 slides to a VC, which were those 3?
I would rather have 5 minutes with them and speak face to face, because I still believe that words speak louder than paper.
Yes.
Nobody wants to read. It's a lot about body language. It's about how you communicate, the chemistry. I used to pitch huge clients when I was in my corporate world, and I knew that no matter how many slides I was presenting in front of them, a chemistry meeting would make or break the relationship. So that is very important. But the opportunities to get in front of these people, that is the difficult part.
Yes.
So how do we get in touch, with Paul and Oliver, for instance, and are they question mark, I don't know much about, we haven't presented ourselves tonight, but, are you lead investor? Are you follow investors? These are super important questions that are not necessarily are always given for granted. And a lot of entrepreneurs, go head straight into this communication. I need to speak to everyone, without doing the due diligence on their end, understanding whether they have done investment in their field, whether they are interested in specific sector, Paul said, no gaming. Have they checked this information? Are you able to do follow-on rounds? Are you able to lead a round? How big is your ticket? What are the metrics? These are information at the moment that are missing, and that are making founders like me spend a lot of time sometimes to actually even find this connection, and then be in front of people, because emailing hundreds of investors, this is so 1990. I'm sorry to say, but I've never emailed or just sent a pitch via website, because I know that 99.9% of the times it goes into the bin, or it goes into an analyst who's probably doing an internship at the fund or that thing, and he's probably not even looking at this, because I'm not a well-known name. So, and because I've heard from experience, from talking to a lot of investors and business angels, that if your pitch is not already on my desk, it means that it's not worth looking at. And that is a problem.
Sarah clearly has outpaced us, but you're completely right. And what we actually do on the basis of a good concept is exactly this. To get into the contact with investors, also even coach the startups, on the founders, how to communicate, how to present, be open, be transparent, be honest. Everything, all of these points contribute to creating trust and believability.
Yeah, and Sarah, this is really, I really love talking to you. It's really, really, really interesting, because you always seem to hear what I'm thinking. Is now that you gave your answer, I have to rephrase my answer to Benedek and Anthony as well. Is I think personally we are doing a 3-step plan, right? And the first is always other way around. The second step is to look at the numbers if everything is there, and then the third step is to get into a personal relationship, right? But to reach out to us, I think it's really needed to that we feel that people did their due diligence, not on just in what industry we are working in and what ticket sizes we do and what our portfolio is, but really look up a little bit what is the background of Paul, what is the background of Oliver, what is the background of Blockchain Founders Fund or whatever fund we are also working with, and not just be treated as VC number 28 in the list of 60 VCs, and you all send them the same copy-paste email, and then you expect us, to spend more than 2 minutes on your project, while you didn't spend more than 2 minutes on writing us an email, right? Because you templated and you sent out the stuff. I know it's sometimes not possible, but maybe then if you have a list of 100 VCs that you would like to work with, then maybe use 90 of those. You template, you write a common email, you make the form field, etc. And the other 10, you really try to make a pitch deck, at least with the logo in, you know, and at least something that they feel appreciated and they feel understood. So you get that first hurdle, right? And you have the attention at least and the believability that you spend the time making sure to meet their requirements. And then everything else comes, like if you have a business model, etc., etc. And then, of course, in a meeting, it's more about personal relationship and not about facts. So that would be that's also needed. So make it personal at first, then have the very basics done, and in a meeting, try to quickly get the facts done and move to a personal free discussion with these people, because they will not remember you if you are fintech number 78, but they will remember you if it's Sarah, if it's Bendek, and they have made you a little bit uncomfortable because they have been asking very good questions. That's what they will remember, and that's when they will come back to you. So these 3 things.
Great insight.
Amazing.
That's good advice.
Much.
So I'll get in touch with you after this call then.
If this is the only winning of this event, which I would be surprised of, but that's already some. Yeah, it's great. It's great, and we'll definitely also on our membership rounds, we will really bring those insights in. Also, as being present here, it makes totally sense, and there were some misconceptions, and there are out there misconceptions, but it's great to hear that good investors and VCs like yourself, Oliver and Paul, you don't get found naked when the tide is out, and that's great to hear.
How do you know? You had this. Yeah.
Great.
No,
Yeah,
it was great to be with you guys.
Absolutely. Just everyone stay around. It's not completely over. But yeah, thank you very much for all these insights. I really liked the few last minutes where we had some really great practical advices. Yeah, so as announced, now we actually have a really cool surprise announcement. I think some of you already know, but yeah, I want to leave the floor to Benedek just to make a quick, maybe 2 minutes presentation.
It will not be longer, because that's not maybe a huge announcement for most of the people, but for our members, it's a great step forward, but also to our future members. So let me just jump in. So the announcement itself is just plainly that we're actually launching a Discord server, which actually will give us a new way of communicating in a structured way on our topics, on our different ideas, which we discuss internally with our members. There's many things on this page. I don't want to go through. It's just a snapshot how it looks like. We have our rules set. We have the server set up. We will be able to do video calls and events within Discord. So everything is up and running from this moment. I just posted it on our internal membership website. And also hereby, I'm inviting those who are not members yet. And this is the moment of some marketing. 3, 2, 1, it's a launch. And to be found is the launch and the link to be joining this membership server on the CVA members networking portal. I can just suggest for the actual members that who already have an access to it to use it, and we will have several initiatives going on there, and also inviting those who are not members yet to join CVA as an individual or as a startup, and see you in our Discord group. And thanks very much for all the participants. I enjoyed a lot, and I think myself definitely, but the audience also learned a lot on how you guys act and what investors really look like in startups.
Absolutely, yeah. Thank you, everyone, so much. I think we could stay here and discuss this subject for hours. There are so many things, so many questions for sure. But I really liked what we talked about tonight. Well, I think it was great. So yeah, thank you, Benedek, for the Discord. I know you done most of the work, so that's great. We're gonna promote it everywhere in the coming days. Yeah, thank you everyone again. Let's connect soon. And great. Have all a great evening, and see you soon.
And nice holidays. Yeah,
Thank
because this is
you.
the last event. Yeah.
Yes,
Thank-
Merry Christmas, New Year.
Bye-bye.
See you
Happy New
in
Year. Thank
January,
you, guys.
guys. Thank
Thanks
you.
so much,
Thank you very
everyone.
much.
Have a
Bye-bye.
good one.
Thank
Cheers.
you.
Bye-bye.
Bye-bye. Bye.